Here's a summary of the UPS second quarter 2026 earnings call transcript, focusing on key metrics and statements. Overall performance and financial highlights. UPS reported a strong second quarter of 2026, marked by significant revenue growth and improved operating profit, largely driven by the successful execution of their U.S. network reconfiguration and the completion of the Amazon glide-down. Revenue. Consolidated revenue reached $22.8 billion, a 7.6% increase year-over-year. Operating profit. Consolidated operating profit was $2.1 billion, up 12% from the previous year. Operating margin. Consolidated operating margin improved to 9.2%, a 40 basis point increase year-over-year, and a significant 300 basis point jump from the first quarter. Earnings per share. EPS adjusted diluted EPS was $1.76. GAAP results included significant transformation charges, primarily employee separation costs related to the Driver Choice Program, totaling $1.05 per diluted share. Free cash flow. Year-to-date free cash flow was $1.6 billion, reflecting one-time payments for the Driver Choice Program. Capital expenditures. Full year 2026 capital expenditures are projected at $3 billion. Dividends. The company plans to pay out approximately $5.4 billion in dividends in 2026. Key initiatives and strategic focus. The company highlighted its successful structural reset of the U.S. business, which involved eliminating lower-quality Amazon volume. Approximately 2 million pieces per day were removed. Network reconfiguration and automation, enhancing efficiency and preparing for higher return opportunities. Expense reduction. Approximately $4.5 billion in related expenses were removed, with more expected in the latter half of 2026. UPS's forward-looking strategy is centered on capturing premium volume from segments like SMBs, healthcare, and B2B customers, with a strong emphasis on revenue quality and margin expansion. They are also investing heavily in RFID and AI to drive efficiencies, enhance visibility, and improve customer experience. Segment performance. U.S. Domestic. This segment showed significant improvement, delivering over 20% operating profit growth year-over-year. Revenue increased by 6% to $14.9 billion, with revenue per piece up 9.3%. Operating margin reached 8%, up 100 basis points year-over-year. Despite a 3.3% decline in total average daily volume, largely due to the Amazon glide-down, excluding Amazon, average daily volume grew year-over-year, and SMB average daily volume increased by 4.3%. International. This segment delivered strong top-line growth with 12.5% revenue increase to $5 billion, driven by an 18.9% rise in revenue per piece. However, operating profit was down $59 million year-over-year, with operating margin at 12.4%, impacted by fuel costs and trade lane shifts. Encouragingly, volume growth returned to the China to U.S. lane, and Asia to Asia export volume increased significantly. Supply Chain Solutions. This segment continued its strong performance with $2.9 billion in revenue, an increase of $207 million, and a $291 million operating profit, up $79 million year-over-year. Operating margin was 10.2%, up 220 basis points. This growth was driven by forwarding, healthcare logistics, and particularly UPS Digital, including Roadie and Happy Returns. Management's forecasts and outlook. Based on year-to-date performance, UPS raised its full-year 2026 outlook. Consolidated revenue, now projected at approximately $91.2 billion. Consolidated operating profit increased to approximately $8.65 billion. Diluted earnings per share, EPS raised to approximately $7.22. Segment outlook, 2026 U.S. domestic. Revenue expected around $60 billion, up 1% year-over-year, with an operating margin of approximately 7.5%. International. Revenue growth expected in the mid-single digits, with operating margins in the mid-teens. Supply chain solutions. Revenue growth in the high single digits, with operating margins between 10% and 11%. Third quarter 2026 expectations. U.S. domestic. Average daily volume expected to decline mid-single digits, with revenue approximately flat year-over-year, and an operating margin of approximately 7%. International. Revenue up mid-single digits, with operating margins between 13% and 14%. Supply chain solutions. Revenue growth in the low double digits, with operating margins between 10% and 11%. Key statements from management. CEO Carol Tomé expressed pride in the successful execution of the Amazon glide-down and network reconfiguration, calling it a deliberate structural reset that has created a leaner, more automated, more agile network. Emphasized that incremental volume now carries materially better economics due to these structural changes. Highlighted RFID and AI as crucial technologies, with RFID acting as the eyes and ears, and AI as the brain of the network, enabling a move from scanning to sensing. Stated the company's #1 priority is moving the right packages and the right mix of volume through our network. When discussing competition, she stated, "We're going to lean into the parts of the market that we want to grow with enabling capabilities that we will do better than anybody else." She also confirmed they have not lost any volume to the specific competitor mentioned. On long-term capital spend, she indicated a structural shift to a lower percentage of revenue, around 3.5%, compared to historical levels, while still investing in growth opportunities like healthcare and specialized logistics. CFO Brian Dykes confirmed strong execution across businesses, particularly in U.S. domestic, in completing the Amazon glide-down and network reconfiguration. Noted that while fuel price volatility increased revenue and expense, the net impact on consolidated operating profit was modest due to surcharge mechanisms. Emphasized the improving customer mix in the U.S., with SMBs now representing 34.5% of total volume. Highlighted that revenue per piece grew 130 basis points faster than cost per piece growth in U.S. domestic, demonstrating expected operating leverage from the network reconfiguration. When discussing the Q2 to Q3 domestic margin, he noted normal seasonality, with a consistent 50 to 100 basis point spread between revenue per piece and cost per piece. Projected a 50 to 100 basis point spread between revenue per piece and cost per piece in the U.S. going forward, aided by base pricing and product mix. Significant risk factors. Fuel price volatility. While fuel surcharges functioned as designed, significant price fluctuations can impact costs and revenue. Geopolitical events. Mentioned war and its impact on operations and trade lanes. Trade policy changes. Evolving trade policies can affect international volume and trade lane performance. Competitive landscape. Ongoing competition, including potential aggression from larger players like Amazon in enterprise shipping. Labor negotiations. The upcoming Teamsters contract renegotiation in 2 years was acknowledged as a future consideration, though management expressed confidence in their ability to manage the process based on existing customer relationships and trust. Economic conditions. General economic headwinds can impact overall shipping volumes. Highlights. Successful completion of the Amazon glide-down and U.S. network reconfiguration. Strong revenue and operating profit growth year-over-year. Significant improvement in U.S. domestic operating margin and profit. continued growth in premium segments like SMB, healthcare, and B2B, advancements in RFID and AI technology driving efficiency and visibility, strong performance in supply chain solutions, especially healthcare logistics and digital offerings, return to volume growth on key international trade lanes, like China to U.S. lowlights, international operating profit decline. Despite revenue growth, the international segment saw a year-over-year decrease in operating profit, impacted by fuel costs and adverse trade lane dynamics. U.S. domestic volume decline, excluding Amazon. While the overall U.S. domestic segment improved financially, total average daily volume was down, primarily due to the planned Amazon reduction. Employee separation costs. GAAP results were significantly impacted by one-time charges related to workforce reduction initiatives. This summary provides a detailed overview of UPS's Q2 2026 earnings call, covering their financial performance, strategic direction, management's outlook, and key risks and highlights.